So, have you opened your money market fund statement recently? You look at the numbers and you just kind of think, huh, is that it? If that sounds at all familiar, then you are definitely in the right place.
Yeah, that feeling of seeing single-digit returns, especially after we all got used to those nice 12 or even 13% numbers, it's real, and it's happening to investors all across Kenya. But the big questions are, why is this happening? And maybe more importantly, what should you do about it now?
And look, this isn't just a gut feeling. The data backs it up. When you look at the net returns from February 2026, even the absolute best performers are barely breaking into the nines. The daily average for MMFs was just 7.62%. So what's the big takeaway here? The game has absolutely changed.
Okay, so here's how we're going to break this all down and get you from confusion to clarity. First, we'll dive into the money market mystery. Then, we'll solve the puzzle of why this change is happening. After that, we'll explore what's beyond the money market, get a handle on the bigger economic picture, and finally, map out how you can choose your own investment path.
All right, let's jump right into this money market mystery. To really understand why your returns look so different now, we first need a super quick refresher on what a money market fund is actually supposed to be doing.
So at its very core, an MMF is meant to be a safe harbor, a safe parking spot for your cash. Its number one job is capital preservation, just making sure your money stays safe, while trying to give you a return that hopefully beats inflation. Think of it as a short-term parking bay, not a high-speed racetrack for your money.
Okay, so if MMS are just doing what they're supposed to do, why the sudden drop? Well, here's the thing. It's not because fund managers have suddenly gotten worse at their jobs. The real answer lies in a really important regulatory shift.
And this right here. This quote from financial coach Susan Wanjiku is the key to the whole puzzle. The Capital Markets Authority, the CMA, they're the regulator, and they've started strictly, and I mean strictly, enforcing the existing rules on how these funds invest your money. This is the real aha moment.
This chart really shows the before and after perfectly. Before, to get those juicy returns we all loved, some MMFs were holding longer-term assets like treasury bonds. They were kind of stretching their low-risk mandate to boost returns. But now, with the rules being enforced, they have to stick to the script, only short-term, lower-yield instruments. The end result? Well, it's lower returns, but it's also a product that's much truer to its original purpose of keeping your capital safe.
And if you take a peek inside a typical MMF portfolio, like this one from CIC, you can see exactly what that mix looks like. See how it's dominated by relatively safe stuff like government securities and bank deposits. The new enforcement just makes sure that the duration of these assets stays short-term, which limits the risk, and as a result, also limits the potential return.
So MMFs are officially back to being safe parking bays. And that's great for things like your emergency fund. But what if you're looking for a little more, growth? Well, it's time to look beyond the money market. And a really helpful way to think about your options is like steps on an investment ladder.
Right down here at the bottom of the ladder, you've got your low-risk MMFs we've been talking about. As you can see, each step you take up this ladder introduces a little bit more risk for sure, but also the potential for much higher returns, all tailored for different goals and timelines.
The very first step up is a fixed income fund, or a bond fund. This is perfect for investors who want a better return than an MMF, but aren't quite ready for the ups and downs of the stock market. And just check this out. The top-performing funds in February were posting gross returns between 11 and 16%. That is a pretty significant jump from an MMF.
Okay, next up the ladder, we've got balanced funds. Think of these as a one-stop shop, kind of like an investment smoothie. They automatically mix and diversify your money across different things: stocks, bonds, cash. They're a fantastic option if you want to get exposure to the whole market without the headache of picking and choosing yourself.
Now we're climbing higher. Equity funds. This is where your money gets invested directly into the stock market. It's definitely a high-risk, high-reward play, and it's best for long-term goals. To give you an idea of the potential, the stock market had a phenomenal run in 2025. It was up 52%. But you have to remember, with high reward comes high volatility. And at the very top of our ladder, we have special funds. Now, these funds have a mandate to invest globally and in alternative assets. We're talking things like oil or gold. They offer incredible diversification, but they do come with high risk, including things like currency fluctuations. But for that aggressive long-term investor, the potential returns here can get as high as 18%.
So choosing a fund isn't just about picking your spot on the risk ladder. Your decision has to be grounded in the reality of what's happening in the broader Kenyan economy. The economic climate is the context for everything we've just talked about.
And for the most reliable snapshot of that climate, we go straight to the source, the Central Bank of Kenya's weekly bulletin. And believe me, this isn't just abstract data. These numbers have a direct impact on your wallet.
Let's quickly decode what these numbers actually mean for you. First up, headline inflation is at 4.4%. That's the magic number. Any investment return you get below that means you're actually losing purchasing power. Then there's the CBK policy rate at 8.75%. That basically sets the tone for all other interest rates. And finally, the shilling to dollar exchange rate, around 130. This is super important if you have global investments, because if the shilling weakens, your global investments are suddenly worth more in shillings.
Okay, phew. We've covered the problem, the reason why, all the different options, and the economic context. So now, let's bring it all together into a simple, actionable framework so you can make a confident decision about what's next.
It really just boils down to answering 3 simple questions. First, what's your risk appetite? And you got to be honest with yourself here. Are you trying to protect your money at all costs, or are you chasing aggressive growth? Second, what's your time horizon? Money you need in 2 years should be in a very different place than money you won't need for 20. And finally, what's the specific goal? An emergency fund absolutely belongs in a low-risk MMF. Retirement savings? Well, they can probably afford to climb a little higher up that investment ladder.
Look, this slowdown in MMF returns, it isn't a dead end. Not at all. It's more like a crossroads. It's forcing all of us investors to be a bit more intentional. By understanding this new landscape and being honest about your own goals, you can turn this moment of confusion into a real opportunity for smarter growth. So, now that you have the map, the only question left is, where will you go next?